Tech can still lead the market, but what we've seen over the last several weeks in particular, but actually this goes back a number of months, is record dispersion among stocks. Think about it, right? Before the bear market in 2022, it was called FANG.
Yep.
Then when we started turning in 2023, we got to the Magnificent Seven. Now it's ostensibly really only the Magnificent Four. And what troubles us when we look at the second quarter expecting more volatility is that Magnificent Four is starting to look a little less magnificent in
But to
recent
be clear
weeks.
here, this is the hallmark of you and Ed Hyman. You're in the market. I don't hear go to cash.
Oh, yeah, no, absolutely, absolutely not. Look, this is one of these times again, and you go back and you think of the times where there may have been emotional reasons, there may have been stress reasons, and March of 2020 is the perfect
Oh, I was
example.
thinking October of '86. Lenny Dykstra's home run in Game 3 for the Mets. The ball has never come down. It went over Everett and was lost over Marblehead. I mean, what the Mets did in 1986, we've never gotten over.
I'm staring at your Red Sox jacket, Tom, and all I can say is Bill Buckner, and I knew you were expecting
Thank
to say
you.
that.
And
we'll
Doug
move
Cass
on.
is on here, so we'll move on. Brammo walked by with a white sign, Bill Buckner. It's opening day. Paul, save us here.
Julian, you and your strategist brethren on Wall Street, I see you guys tripping over each other trying to keep raising your year-end targets for 2024. How are you thinking about valuation here? Because
This is the arch question. Paul,
okay.
this is the single best question out there.
We're taking a different tack here, Paul. Okay, and it is earnings and valuation driven, as it should be. Now, I will say this: is that my focus on valuation has been unlike anything I recall in my career. Frankly, I was managing money in Y2K, so that's why. The first thing we have to do is step back and say the market is exuberant, but it is nowhere near irrational. 28 times what you saw in Y2K, which would imply 6,200 or so in the S&P,
Wow.
is exuberant. But from our point of view, with the accumulated sort of perfection priced in and the possibility that the Fed isn't going to be able to deliver, and that 11% earnings growth, which has been basically the baseline for the last couple of months, has downside, as we think it does. The way you want to think about this is, how do you stay in your core positions with perhaps a tilt towards defense and not get scared? Because the history of making subpar returns in investing comes from selling into down markets, as opposed to just sort of thinking about how you position when things are good, as they are now.
do we still chase this market? I mean, if I chase this market, I feel like, and I'm Joe, portfolio manager out there, Joe, an investor with my 401k, I feel like I have to be in those magnificent 4 or 5 names, whatever they are.
Well, so actually the amazing thing is the options market this is one of these very rare times where you're allowed to have your cake and eat it too. Because the combination of this incredible retail investor FOMO, remember, the market is being moved in large part by 0 days to expiration options trading on the part of the public, where you control $1 million worth of stock for less than $10,000 and the position closes every day. That kind of FOMO and 5% interest rates give you the ability to stay in those Mag 7 names, but actually have downside protection.